Okay, well, welcome. My name's Mark Fielding Pritchard. I've made a number of these videos to go onto YouTube and go onto the internet. And I do these mainly because I know that I've got courses coming up and it's a good way for me to prepare. What I'm going to do over probably the next few months now is I'm going to put up an introduction to accounting course. So this is the real basic course for people who've got no knowledge of accounting whatsoever, and it will lead you towards ICAS, which is Institute of Chartered Accountants of Scotland, ACCA, ICAW, which is the English Institute. Those exams, but at the very, very basic level. So you're down at level one. I'll try to keep the lectures nice and short. My students always like it when I keep lectures nice and short. And then on that basis, you can flick through them. And then if there are lots of different videos and stuff, then you can look at the videos for topics that you're having problems with. I'll also put this up on my website. The website is called mefielding.com. So you can have a look on the website and you'll be able to see them all there. And if I use slides, then you can download them from that website as well. Okay. So over the course of the next few weeks or months or however long this takes me to do this actually, because it's a fairly chunky piece of work, what are you actually going to do? Well, in terms of what you're going to do or what accountancy really is that accountancy is a language. So we're going to learn to speak some or a good chunk of the language of accountancy. If you think about a business, even if it's a small corner shop or a guy running a taxi, the guy is undertaking financial transactions. He sells some cigarettes, he sells a newspaper, he sells some bottles of Coca-Cola, and in return for that, people give him money. Excuse me. At the same time, he purchases those goods. So he purchases cigarettes, his newspapers, and he gives money for those things as well. Those are individual transactions. So what we do with those individual transactions is that we capture them. So you actually capture the individual transactions and you record them in such a way that they can then be grouped. So you will have all of your purchases of goods for resale. You will have your overhead, so your payment of your staff, your rent of your shop, and so on. So you're learning to speak a language. Right, and the process is the same as learning to speak a language. So there will be certain points in time when you just have to go, well, that's the way it is. Can I actually say, as a teacher, I have been on IASB committees, I've done derivative accounting for Central Bank of Russia, and I've taught what is a debit, what is a credit, and you'll come to that in the course. The teaching at this level is actually much, much harder. So for you guys, this is the hardest bit. If you can get through these initial courses, you'll find as you go through it, believe it or not, it actually gets easier and easier. And it's the same as, if you're British and you're learning French, the hard part is learning the verb structures, learning what the nouns do, learning the plurals and so on. And then you just keep applying it until you reach a point when it kind of makes sense. So that's what we're going to do. We're learning the language of money or the language of accountancy. Once you've learnt that language, you will then learn how to record information. Once you've recorded it, you'll learn how to group it. So all of your purchases of newspapers within a given period of time appear in one way. And then you'll learn how to show it, to present that information. So you're going to look at the profit and loss account, the balance sheet, and the cash flow. And then you'll learn how to do some analysis and how to explain what those numbers actually mean. So we actually find that by selling bottles of Coca-Cola, we're making a small loss, in fact, but by selling newspapers, we're making profits, or whatever happens in the business. To summarize, you are learning a language. Okay? Once you've learned that language, you learn how to record in the language, you learn how to summarize, and you learn how to present. The key topics that you will go through, you will learn wonderful things, and you'll understand. If you don't know what these things are, it doesn't matter. You'll learn them as you go through. So you're going to learn T accounts. T accounts you'll see like this, or I used to teach in Russia, so as Russians call them baby aeroplanes. So you'll learn how to do your T accounts. Oh, I'm looking at my slide now. You'll learn some accounting concepts. So what are the rules that underpin what we're doing? The same as French verbs have rules and so on. And you'll learn the profit and loss account. How much profit have we made? Yay. So that's cigars, champagne. The balance sheet, does it balance? Let's hope so. And finally, we'll look at the cash flow statement. So this is going to take me few months to put all of this up, and it's going to take you a few months to work through it. So don't worry, don't hurry. Just keep doing what you're doing and stick with it, and away you go. We're coming on to the next slide. The next slides and the rest of this video, in fact, are going to be just a nice little introduction. So can I please suggest that you print off the slides? So get those slides printed off, and then you can tick them off. Get yourself a cup of coffee, put your feet up. This isn't massively important what's coming, but you need to know it, and it's part of this idea of having a rounded knowledge and a rounded understanding of business, which will make it easier for you to understand the specifics of accounting. Looking at my picture here, God, I need a haircut, don't I? I'm tired as well. It's a stress. I'm married with 3 children. It's actually my wife's birthday today. I'm married with, I won't tell you how old she is. Oh, much older than me. I need a haircut. Right, moving on to slide number 3 then. Slide number 3 here. Right, this is all the I just move around in front of me. So I can't actually see it on the screen when I'm making these videos. Right, so slide number 3 is just some general questions that I want you to think about, because what you're going to be doing is you're preparing a set of accounts. We talked in this last slide about how you have people who are running a little corner shop and they're buying some newspapers, they're buying some Coca-Cola, they're buying some packets of cigarettes, and they're selling them. And we are going to record that information, and then we're going to summarize it, and then we're going to present it. We said those are the 3 stages we go through. What's really important, and this is what accountancy is all about, is what are those people actually going to use that information for? So we're going to be looking, I think, in slide number 4, at who are the users of accounts. But your accounts, therefore, to be useful pieces of information and to make it worthwhile for you paying an accountant to prepare the wretched things, and let's be honest, we're not cheap as a profession, that they have to fulfill your needs. To understand what the needs are, let's just go through a little step back. And I've written a list of questions there, the kind of things that will be driving what people will use accounts for. God, that's good coffee. Right, so why do people own their own businesses? So why do you go into business? Well, I mean, your alternative is being an employee. So therefore, being an employee, we all have bad days at work. So you have a crap boss, you want more choices. Some people do it because they get made redundant. Other people do it because they have a particular talent. So you have a particular talent, and therefore you want to do something. I've certainly worked with people manufacturing jewelry and things like that in the past. So because of your personality or because of financial reasons, I used to work for a big 4 accountancy firm. I wanted to set up my own training company, and I thought I could be a lot more financially successful. I could sell a lot more training than the big 4 accountancy firm was, but because of the restraints they put me under. And to their credit, they disagreed. They're still doing training to these days. So just think for a second yourself, and if you can be bothered, it might be worth just jotting a couple of these things down. This isn't going to be in an accountancy exam, but it's the kind of things that, if you're going to be going into accountancy, and you're dealing with people who are running their own businesses, why are they actually doing it? What's actually driving them? Is it money? Is it a desire to do it their own way? Is it necessity? Some people get made redundant and they open a business as the only way of earning a living. So what are they actually doing it for? Other things there, it says, what should you consider before setting up your business? Well, there's a number of factors, and you should really always do a business plan and sit and work out, particularly what can bloody well go wrong when you run your own business. Because everybody goes into it like, Del Boy for Only Fools and Horses. We're all going to be millionaires this time next year. So where are you going to get the money from, and how much do you need? Right, just think about your different types of business. Going into a business like this, I need a laptop and a printer. I have clients and I have people who work for me, but in principle, I need a laptop and a printer. So it's virtually nothing. Right, now think about an electricity generating company. How many of you fancy quitting your jobs tomorrow and setting up your own electricity generating company? So where are you actually going to get the money from, and how much do you need, obviously? Your various choices are the bank of mum and dad is a personal favourite, I think, of everyone. I don't think there's anyone in business, even senior partners in PricewaterhouseCoopers, who haven't used mum and dad at some point. Mum and Dad, are you going to borrow it from the bank? The obvious choice as well. Most popular businesses, God forbid, God knows why, hotels and restaurants. You need more money for that. You can't just do it off the back of a laptop. So you get the money from the bank. Yeah. So what's the sources of funds? When your businesses start to get bigger, then you can start looking at equity issues and where that kind of money is going to come from. So just think about the sources of finance. Raising finance for small businesses is a huge problem. Um, Banks don't like to give it to small businesses because they have a horrible tendency to go bust. And there's only so much you can tap your mum for. Other things which are on the slide there. Let's skip one now and go, what assets would you need? So this is an important one. For those of you who studied any management theory, you'll know one of the big questions, what are your barriers to entry? The more assets that you need. So what do you actually need? And don't forget that with these sources of finance, there's things like leasing. So nowadays, we bought a hotel not long ago, and all the assets in it were leased. When I say the assets, the fridges, the freezers, the cookers, the tables, and everything that belonged to this. It had a whole ground floor as a restaurant. It's all leased. All comes from a leasing company, and a leasing company is just a function of the bank. So what assets do you need? Right, probably more difficult in the long run, therefore, is how do you know how much you're actually going to charge? How much are you actually going to charge for these goods? But that's going to be dictated to you by geographical location and the market that you're in. That is a big problem. And you certainly get for certain items which are in very mature, very competitive markets, you'll get market pricing. So things like Mercedes-Benz. Mercedes-Benz will know how much they can charge because it's dictated by the market. Same for Coca-Cola. Are you the same for your product? Accountancy firms the same. If you're a small accountancy firm, you can't charge as much as PricewaterhouseCoopers. They have the brand. So how much can you actually charge? Right, why do you need to keep financial records? Right, very simple ones. Taxman. Every country I've ever worked in, even if it's Turkmenistan, you have to keep records for the taxman. So the taxman will dictate what records you want. You are not going to be much of a businessman if you do not keep financial records. So you need to know yourself, how is your business performing? And you should have records by product line and so on. We talked about the corner shop, Coca-Cola newspapers. All of these little packages that you can buy for a couple of £100 now will all produce this kind of information for you. So you need to keep records for yourself and for the taxman. How do you measure whether you're being successful? That's probably going to depend a lot on your personality. If you are someone who's very, very creative and you think, oh my God, I've just made this fantastic necklace because I'm a jewelry designer, then that's probably enough for you. For other people, the key measure is going to be cash in the bank. And you'll come to see later that profit and cash in the bank are not the same thing. So it will be cash in the bank or profit. And for other people, there's all sorts of measures. If you're really bored, go away and Google a thing called the Balanced Scorecard, which is Kaplan and Kennedy, and there's all different ways to measure within the Balanced Scorecard. People think accountancy, they think the measure is money. Can I just say that money is certainly not the same as happiness. So different people will have different things. And finally, who will be interested in the performance of your business? Well, we'll come on to list the users of accounts in a minute, but you're going to have a whole load of people. You, if you've borrowed money from the bank will, and then there can be a whole load of other people. People who are giving you credit for goods will want to know, make sure you can pay. We talked about the bank. If you've got employees, they might be interested to know how to secure their job. And so we'll come on to users of accounts in a second. Okay, that was just a general little chat. What I want you to take away from that, I want you to think about someone who is starting a business. What is driving that process? Because what drives that process of starting and then subsequently running a business will drive what it is that they want to get from the accounts. You are an accountant, you are producing information. That information is intended to be useful to people. So what uses will those people put these things to? So in the previous slide, we looked at this concept of why do people particularly start businesses and why do they run businesses. So let's just run back through why this is important to us. You are preparing, as an accountant, information. And that information, we talked about this idea of recording, summarizing, and presenting. Now, the form that takes and what you're actually trying to do will depend on the people who are the users. So when we looked on our slide there, we talked about this idea of why do people start businesses? How do they measure their success? And please do remember that not everyone will measure their success in the number of pounds in the bank account. What we're now moving on to, therefore, is this idea of users of accounts and stakeholders. It's a continuation of the process. We said there was a process, therefore, of recording, of summarizing, and presenting. So when we're talking about these things now, we're talking about the final account. So an actual proper set of accounts, and that set of accounts which will show the profit, and will show the assets in the balance sheet, and will show the liabilities in the balance sheet. Now you need to think, therefore, and I think from this list, first of all, is who are these people? So from the first version of the slide, I've added at the bottom there. So the directors of the company will want to use it to see how the company is performing overall. I will promise you that while people may be driven by their personal happiness or their desire to create, money will still play an issue there, and we are being driven by money here. So the directors will look at the money. You've got down there, you've got the shareholders as well. And in 99% of businesses, the directors, managers of the business and the shareholders will be the same. It's only when you come to the Ford Motor Companies, the Philip Morris's, the British Telecoms that you get this separation. So you've got this idea of the directors and the shareholders. We've also got the general public. The general public may, with certain types of interest vehicles, be interested in what's happening, particularly if you're a nuclear power plant or something like that. You're going to have the creditors of the business. So the creditors of the business will be interested to know, are they going to get paid? You have the bank if they've loaned you some money. So all of these people will have an interest. But one other one as well is the debtors as well. Don't forget that the people who are buying from you, they also want to know because they want continuous supply. You're not going to buy a car if the car company isn't going to manufacture that car in 6 months' time and you can't get spare parts for it in the future. So you've got this list of people. Again, at the moment, these are all just general concepts and general ideas. So what probably the best thing to do is turn me off and shut me up, and then just have a cup of coffee, and then just have a think about who uses accounts and what is it they're actually going to do therefore. So we've got this idea of who's using them and why are they using them, and the what here means what are they particularly looking for. The bank, if they've loaned you money, can you make the interest payments? Are you going to be able to repay the capital? The general public, are you dumping crap in the river? The directors of the company, are we making enough profit? Are we reinvesting in the business to keep it growing? And so on and so forth. Right, there's just one little thing there. This is something to do with sort of parallel topics with accountancy, but it's strengths. So you're going to have the various strengths. Now these people that we've got there, we call the stakeholders. They will have relative strengths. In a small business, the people with all of the power are probably going to be the directors because they provided the finance, they manage the company. Certainly, if you go on and do ACCA, ICAS, something like that, you'll get different types of businesses. So you may find one that came up in one exam that I liked was a theatre. And so the government, for example, had a say because the Arts Council was providing money. There was also Friends of the Theatre who were providing money and they had a big say. So the people who are providing money, who are driving the management of the business, what strength do they have? Can they make you change things if they want to? Again, it'll depend on business to business, and to make it a bit more fun, people like ACCA and ICAS and ICAW will give you questions about businesses that aren't standard manager shareholder businesses. And then the final point on the slide, therefore, is then how do you balance the requirements of all of these different groups? To be quite honest, when you first start, the accounts are going to be there to show the owners, managers of the business, how the business is doing, and many of those businesses will run off of some glorified version of a bank statement. How much cash is in the bank, and then how much am I waiting for from my credit customers? How much have I got to pay to my credit? How much have I got to pay to my credit suppliers? Customers and suppliers getting the right way around. As the company becomes more sophisticated, the requirements will become more sophisticated as well. There you go. We are a sophisticated bunch as accountants. So we're now up to slide number 5. I think we are now. I don't really want to go into this in massive amounts of detail because this again is an entire topic all in its own right. Um, we've talked about preparation of sets of accounts. There are, in general, as a very broad rule, 2 different types of accounts. We call them financial accounts and we call them management accounts. The financial accounts are the accounting statements where we have international accounting standards. These are the ones that go to the taxman and they get collected in. And if you Google accounts for British Telecom, Ford, or someone, this is what you'll find on the internet. In addition to those, we also have what are called management accounts. Management accounts are prepared internally within the organization, and they are, as the name suggests, for use by the management. They have no set rigid format. You can pretty much do what you want, but the objective, of course, is that they are to provide useful information, and it's going to be financial again, for people within the organization to make management decisions. So this is just a very small slide here. If you want to go and read about this, one of the best places to look is IKEA. Look at IKEA's website and they talk about objectives and goals and stuff. But here we've got this idea of objective settings. So go have a Google on mission statement. And this is what is the organization trying to do overall. So it has some aims, it has some goals, and so on. And this is what they're trying to do. Certainly, I remember that KPMG at one time wanted to be the auditors to 30% of quoted companies in any jurisdiction. And you'll see again that this thing breaks down and you start studying further through ACCA and ICAS. So you'll get mission statements, you'll get goals, you'll get objectives. So what overall is the organization trying to do? The key topic or the key word here is the concept of strategy. So what happens with strategy? What are we actually trying to do? Next level down, we've got this idea of plans, tactics, and operations. So plans, tactics, and operations is what is the organization doing on a day-to-day basis. So when you look at operations, you have your budgets. So what are your budgets there? Your tactics, as far as IKEA are concerned, is how do we deal with our competitors? So again, what are we actually trying to do there? And so that's this idea of setting a strategy, working towards the strategy, monitoring progress of the strategy, right the way down to what happens on a day-to-day basis. Finally, we've got this idea of performance monitoring. So performance monitoring is where you have your actuals and you have your budgets. So we're comparing actuals and budgets, and we're looking at calculation of variances. Variance is just the difference between actuals and budgets. But the point is, you don't just calculate them, you then investigate them, and the ones that you don't like, you try and change. And finally there it says ethics. Ethics is a strange topic. Most companies will do the right thing, but only after they've explored every other option. So with ethics, we have this idea as well, therefore, that are we going to behave ethically? And usually the aim of government is to make ethical behavior financially worthwhile as well. So we put in there this ethics as well. And many companies now are bringing in green accounting, and there's definitely a move of trying to look like you're being ethical. Whether people would argue that you actually are or not is a different question. So our final little session then. Final little session then before we end this introduction to the introduction. As you can see from this final little slide here, the first 3 things there are called sole trader, partnership, or the first 3 words, the first 3 little lines of sole trader, partnership, and limited liability company. Right, these things relate to the different legal forms of business. Right, what does that mean? A sole trader is a person, an actual human person, who is trading as a business in their own right. So therefore, Mr. Smith decides to open Mr. Smith's accountancy training firm, do some videos, and try and put himself out there to win some training courses from some governments or from some accountancy firms. Mr. Smith therefore invoices in the name of Mr. Smith, and the business is his. Where these things become important is from the legal basis of what actually belongs to the business, right? What does that actually mean? Let's assume that Mr. Smith decides that he needs a van for his business to carry projectors and books and stuff. If you step out into the street and get hit by that van, assuming it's Mr. Smith's fault, you will sue Mr. Smith. So Mr. Smith has a van, you've been hit by the van, you're on a zebra crossing. Who do you sue to get compensation because you can't work and because we live in a world now where everybody sues for everything? You will sue Mr. Smith as an individual. And therefore, if you win £1 million from Mr. Smith, he's going to have to pony up his house and his car and his savings and so on and so forth. So this idea that Mr. Smith is trading as an individual. Right, these ideas of why are these different legal formats important? They're important because they will affect the presentation of the accounts. The information that Mr. Smith gives in his accounts will be different from the information which is given from a partnership and a limited liability company. So that's this idea, therefore, of a sole trader. It's to do with the presentation of accounts, and certainly from a tax basis, they want to see what's happened to the profit. So in other words, how much profit has the business made? And then they want to see how much of that profit has Mr. Smith taken. And if Mr. Smith has taken more money out of the business than it's made in profit, then where has that extra money come from? So sole trader is an individual. Legally, therefore, there is no legal distinction between the business and the individual. Right, with a partnership, let's assume that Mr. Smith is doing well. He's got loads of contracts. He needs to take someone on, so it comes to someone like me. He says, "Hey, Mark, why don't you come and work with me? And we'll split the profits between us on some pre-arranged percentage." Right, at that point, it becomes a partnership. Legally, you're going to come across words called joint and several liabilities. If the lorry smacks into you when you're on a zebra crossing, you can sue Mr. Smith and you can sue me because I'm a partner in the business now. And it doesn't matter what the proportion, what the split of profit is. And please don't, it doesn't have to be 50-50 if there are two partners. It can be any proportion that we agree. But we've got this idea of joint and several liability. So therefore, a partnership in the capital section will have a different format from a sole trader because it reflects the fact that different bits of profit belong to different people. But we still come back to this idea that you are jointly and severally liable. You have joint and several liability. Right, the third one is a limited liability company. As far as the law goes, a limited liability company is a separate person. You step out onto the zebra crossing, you get hit by the lorry, and the lorry is owned by Philip Morris. There is no Mr. Philip Morris that you are going to sue. Philip Morris is a company, and therefore you will sue Philip Morris, the company. Right, so you get this idea in your mind that we have a separate legal person, and therefore, if it's Mr. Smith now, he incorporates, so Smith Training is now a company. Mr. Smith will be an employee, and his relationship with that company is an employee. The company pays him a salary. You get hit by Mr. Smith's lorry, you sue Mr. Smith, the company. It gets very, very useful when people become wealthier and wealthier, because if you sue the company, Mr. Smith can hide his assets away, and if you get hit by his lorry, then you can't touch his personal assets. So we've got these three different forms. As far as accountancy is concerned, and you'll come to this as you go through this course and into later courses, that will affect the presentation of the accounts. The requirements to prepare accounts, the information requirements which are given to you either by accounting standards or by the government will change depending on whether you are a sole trader or a partnership or a limited liability company. For the purposes of this course, it doesn't matter, it doesn't make any difference. We'll show you, or I'll show you later on, balance sheets and profit and loss accounts and so on, and they're going to be for limited liability companies because the accounting standards are written for limited liability companies. But the basic nuts and bolts of preparation is the same for all three. As you go further through, it'll become more important. Just one final little thing that's at the bottom there is called unquoted and quoted companies. Right, there is a thing called the stock market, the stock market, as the name suggests, is a market. So if you think about your local market, you go into the market, you want to buy some jeans, you go over here. You want to buy some fruit, you go over here. You want to buy some vegetables, you go over here. And the other thing about the market is it may be that if you take your goods in, that the people on the market stalls will buy these things from you. So you may, if you've grown some potatoes in your garden, you've got some eggs, or you've got some second-hand jeans to sell, you may be able to take them down the market and sell them as well. So you get this idea of market stalls which are buying and selling goods at the same time. Obviously, they buy for less than they sell for, because that's how the world works. The stock market works exactly the same. So therefore, in the stock market, you have stalls. Now, until 1987, when Margaret Thatcher closed it, it actually was a physical market that people could go into, and it had physical stalls. As the internet has developed and computer technology has developed, and I'm showing you that I'm nearly 60 years old now, that market was closed, and the floor of the stock market, this is London, the London stock market closed. So now it's all done in the computer, but the principle is exactly the same. Now, if you want to buy Levi's jeans, there will be a stall selling them. If you want to buy oranges, there will be a stall selling them. There will be some things that when you go into the market, you can't buy because there's no one selling them. So you go down the market and you happen to have some special oil that can only be used in combine harvesters. Right, well, you can't buy it anywhere and no one's going to buy it from you. Right, that concept exists with companies as well. The stock market buys and sells shares. British Telecom, I don't know, Ford, I guess, America. Ford will be quoted on the New York Stock Exchange. HSBC is quoted on the stock exchange. You've got Next, you've got Tesco's, you've got Safeways, and so on and so forth. These things are quoted because when you go into the market, there are some stalls somewhere that are buying and selling those shares, in the same way that there is oranges and Levi jeans in a normal market. So if you get shares, they're very easy to sell. You take them down the market and you sell them. They're doing really well for you, nice dividend, good profit. Yeah, life's good. You want to buy some more, you go down the market and you buy them in the market. Those things are called quoted companies because you can do that. You can go to the market. In Great Britain, approximately 1% of companies are quoted. The other 99% are not. So we talked about combine harvester oil when you live bang in the middle of London. That is unquoted. So if you want to buy more combine harvester oil, God forbid, or sell the combine harvester oil that you've got, you need to go through special procedures to find special people, and you need to phone up the local National Farmers Union or whatever, blah, 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 blah. That is the difference. Now we have an unquoted company. The shares on that company are not quoted in the market, so you can't go down the market and buy them or go down the market and sell them. You have to find special people, right? That will affect several things. One is the accounts. What goes in the accounts, what's the format of the accounts, what's the disclosure requirements. Quoted companies will have specific disclosure requirements which the stock exchange sets for them. Unquoted companies are not governed by the stock exchange. Not interested, do what you want. Right, that last lecture therefore is just background information, but you need to keep that with you. It will become much, much, much more relevant the further you go through the course. Sole trader partnership, limited liability, different legal forms of a business, but they will affect the presentation of accounts. Quoted and unquoted is the same again. That's information that you should have. Okay, that is the end of lecture number 1. That is the introduction to accounting. I hope that you found that interesting. I hope that you spent, and this particular slide's been on for 10 minutes now. I hope you spent the last 20, 30 minutes with your feet up reading this, and it's been relatively interesting. And let's be blunt, there's nothing in there that's going to test you in any way. There's nothing you're not going to understand from that. It's background information. We're then going to start going into how do we record information, and that's what's going to be coming in lecture number 2. Thanks for listening. We'll put the slides and the video up onto the website, and you can go on the website, you can download them, and you can print them, and you can contact me through the website should you have any questions on this. Hope you enjoyed it. Does anyone enjoy accounting? Have fun.